Good afternoon, everyone, and welcome to our session on real estate, private credit, and rising rates. My name is Hanna Sundqvist. I'm the head of private credit for Europe at Moody's, and I'll be moderating today's discussion. I'd like to start by thanking Private Markets Group for bringing us together, and of course to our panelists for joining the conversation. This session focuses on how family offices and institutional investors are navigating private credit and real assets at a time when interest rates remain elevated and, perhaps more importantly, less predictable than they were for much of the last decade. The backdrop is familiar, but it's still evolving. We're seeing higher financing costs, slower growth, and ongoing geopolitical uncertainty are reshaping how risk is assessed across private markets. Assumptions that held in low-rate worlds around refinancing, asset values, and downside protection are being tested in ways that are uneven and highly dependent on structure, underwriting discipline, and behavior. From a private credit perspective, what we're seeing is continued market momentum, but with risks becoming more dispersed. Outcomes are increasingly driven by leverage, cash flow durability, and structural protections as complexity and interconnectivity across private markets grow. So over the next 45 minutes, we'll explore three things. First of all, how investors are reassessing risk and allocation across private credit and real assets. Secondly, how fund structures, governance, and legal frameworks influence outcomes when conditions tighten. And finally, what really matters most for returns and capital preservation when markets are less forgiving and where selectivity matters most for family offices today. I'm joined by two panelists who bring complementary perspectives across private wealth and fund structuring. Joseph von Maltzahn, who's head of private wealth EMEA at JLL, and Oisin McClenaghan, who's partner and head of investment funds at O'Gear. Now, I'll ask each of you to just briefly introduce yourselves and your current focus, about 30 seconds each if you would, and then we'll get straight into discussion. Joseph, do you want to start?
Sure. Thanks very much again for having me on the panel and looking forward to the discussion. So my name's Joseph von Maltzahn. I work with Jones Lang LaSalle. So we're a New York listed real estate advisory company. We are trading across the globe on average around $1 billion worth of real estate every day. So there's an enormous amount of volume of transactions that are going through. And obviously that then translates into a lot of data so we can see what's happening, what the trends are, and where we think the markets are going to go. My personal role is leading our private wealth team across Europe. So we have a network of people specifically speaking to and advising private clients around Europe on their real estate needs, how they can find investments, how they can manage investments, and how they can exit investments.
And thank you, Hanna. Delighted to be here this afternoon. I head the funds team at O'Gear's Irish office in Dublin. Myself and my team advise asset managers and family offices on the establishment and the servicing of their Irish fund structures. We are the Irish arm of the global O'Gear firm. So O'Gear is an organisation. We have full service law firms in Ireland, Luxembourg, Cayman, BVI, Jersey and Guernsey, and fund admin, corporate fiduciary servicing capability across all of those jurisdictions, in addition to servicing Dubai, Delaware and Singapore structures. So in short, we service fund structures in all the major global international financial centres, both legally and operationally.
Super. Thank you both so much for joining. Let's dive into it. If we start by looking at risk and allocation perspectives, I'd be interested to hear you, Joseph. Are you seeing changes in how family offices are assessing risks today? So, for example, around leverage and liquidity or financing structures compared to what it looked like a few years ago?
I think it's a really interesting question, especially when it comes to family offices and real estate. Oftentimes, it very much depends on the strategy of the family as to whether they will take leverage at all. There are many families that don't use leverage. But if we focus on the ones that do use some leverage, typically they're on the more, I'd say, value-add, opportunistic spectrum, where they are buying real estate and using real estate not as a wealth preservation tool necessarily, but as a wealth generation tool. So they are looking to buy real estate, invest in it, fix it, release it, and then trade, much as you would see a private equity business engage in the real estate markets. And those families, while they can use leverage, and they often do, I think each one is very different in terms of how they look at it. Some you would see them using sort of 60% plus leverage, and others you would see using 30% leverage, and some maybe none. So I'm not sure that given the current climate that's really changed. I think that's down to an individual sort of risk appetite rather than what's happening in the market. I think on the liquidity side, though, that's where the markets in the last few years have become really interesting around Europe and globally on the real estate side. And what we've seen, if you have to make sort of gross generalizations, is that central business districts and centre of towns have seen their liquidity levels hold up pretty well. And yes, people might not have got the price that they were hoping for, but they have got a price and they have got a trade which is acceptable to them. There are other parts of the market where pricing has dropped quite considerably, and there has been a liquidity issue in some of those assets where if there was a counterparty, it certainly wasn't at the price anywhere near what people were expecting or was palatable, and sometimes there wasn't a price at all. So I think that's been a change, and it's something that we've seen, and the market has repriced most of that sort of risk of liquidity quite well, I would say, in the last 12 to 18 months.
And how do you think investors are assessing or reassessing rather liquidity in real estate today? And where would you see the biggest gaps between perceived and, I suppose, actual liquidity?
I think it's a good question. I think the office market is probably the easiest place to start seeing where liquidity is, and there's obviously the sort of myth versus reality in terms of what people are using offices for and whether offices are going to still be a thing. We clearly see that offices are very much still a thing and becoming even more so. There are many anecdotes of occupiers that renegotiated their leases during and after COVID, reduced the amount of space because people were going to be working from home, and now find themselves in a situation where they're committed to a long-term building, but they don't have the space that they need, and they're trying to find space in adjacent buildings or in the same building when it's multi-tenanted. So those are real stories where back to the office is happening, and you see it in the press quite regularly about some of the big tech firms calling people back to the office, the big financial institutions calling people back to the office as well. So that's something that I think we've moved past that stage now of whether office is still a valid asset class. And if you look at last year, the numbers that we had, it was definitely back on the table, back on the agenda from investors' point of view in terms of looking at that asset class again. When it comes to the liquidity, that we were at a point when yields were pretty compressed, I would say, pre-COVID, just after COVID, and the gap between sort of in-town and out-of-town office buildings or in-town and out-of-town retail was very narrow. That has definitely changed, and I would say that's why I say that I think that sort of liquidity risk has certainly been priced in nowadays.
Interesting. Now, from a structuring perspective, where do you see the biggest mismatches today between investor expectations and that reality of liquidity and risk in real estate as well as private credit vehicles?
It's an interesting question, Hanna. Very, very topical as well. It has been for the last few years. So yeah, there certainly are expectation mismatches between investors and the terms they're legally bound to, and those mismatches are pretty widespread. So it may seem obvious, but I can't emphasize enough how important it is from an investor's perspective to fully appreciate the extent of a manager's ability to refuse to meet redemption obligations based on LMTs, so liquidity management tools that are frequently incorporated into a fund structure and disclosed in the fund documentation. From a manager's perspective, it's key that promoters realistically assess potential illiquidity and align portfolio illiquidity or liquidity with the redemption profile of the fund, and build in the tools to be activated in the event that liquidity is stressed, and clearly communicate and agree those terms with investors in the fund documentation. So just to pause briefly on the main LMTs, so the liquidity management tools that we frequently build into fund structures for our promoter clients, and frequently field questions from investors on when we're assisting investors with their onboarding due diligence prior to investment. Suspension of dealing is the main LMT. so denying investors the right to receive redemption proceeds. This is obviously the nuclear option in most fund structures. Understandably, fund promoters, managers are very wary of activating their ability to suspend dealing. It would be a fairly standard pre-investment DD question asked of a fund promoter as to whether or not they've ever suspended dealing on any of the funds that they operate or run, and would be seen as a red flag by investors if the promoter had suspended, unless it could be clearly and understandably explained. Redemption gates are also a popular LMT, liquidity management tool, so capping redemptions on a redemption dealing date, say 10 or 25% of NAV. So how this gated redemption is dealt with is key from both a manager's and an investor's perspective. So frequently there can be a lack of understanding around just what happens if your redemption is gated. So say, for example, a fund has a 25% gate facility on any redemption day. There's say market turmoil or some sort of geopolitical crisis causes a rush of redemptions. 40% of investors are looking to get out on a dealing day. 25% are redeemed, typically prorated down on the dealing day, which means that 15% of those redemption requests weren't actually processed, and they get pushed forward to the next redemption dealing day. The big issue here is whether or not they will be dealt on a first in, first out basis on that subsequent day, or aggregated and treated equally. So the aggregation approach is favoured by some regulators. So they insist that their funds in certain jurisdictions have this aggregation approach to avoid incentivising rushed redemptions in a distress situation. So in other words, if investors are treated on a first in, first out basis on subsequent redemption dates, they're incentivized and more likely to submit redemption requests to get ahead of the queue. Whereas in the aggregation scenario, if so those gated redemption requests are simply processed pro rata with any new redemption requests received on the subsequent redemption dealing date. So again, just in terms of expectation mismatches, it's key to actually appreciate the nuance of how those gated redemption requests are going to be dealt with on a subsequent dealing day, if you're an investor, but also if you're a promoter manager setting up a fund structure. Extending redemption notice periods are also common, so it would be a discretion for a manager to extend or impose lengthier notice periods. So instead of, say, 180 days prior notice, providing for 360 days notice in certain circumstances disclosed in the fund documentation. The ability to apply discretionary redemption charges is frequently built in and may not be fully appreciated by investors. In specie or in-kind redemptions, so forcing investors to accept assets in lieu of cash, is also a frequent liquidity management tool built into the fund documentation. And again, the nuance around that really needs to be understood by an investor prior to any investment. Again, this varies by jurisdiction in terms of what the safeguards are and what the local requirements are in terms of how an in-kind or in-specie redemption is dealt with. So in Ireland, for example, in an Irish regulated fund product, it is not possible for an investor without their consent to be saddled with an asset in lieu of a cash redemption. Typically, what the promoters have the ability to do is to propose a redemption in kind, and then at the request of the investor, sell the asset in the marketplace, deduct dealing costs and pass the cash on to the investor. So that is an outcome which is not ideal, but it's preferable to an investor being lumbered with an asset that they don't have the capability or the ability or interest in physically holding. Side pockets are also commonplace. So the ability to essentially hive off an illiquid or problematic asset into essentially what is a de facto parallel sleeve or sub-fund. And then in the case of fully closed-ended funds, key to look at what abilities are there for the manager to extend the closed-ended period and extend the end point of the fund. So these LMTs are very much in focus under the new pan-European AIFMD2 framework. So that's codifying what is already more or less industry practice across the key EU jurisdictions of Ireland and Luxembourg. But these LMTs are being codified and will be applicable from April to the funds industry across the whole of Europe. So, I mean, in my world, in the Auger world, in the international financial services world, we're very familiar with Ireland and Luxembourg as key European jurisdictions. But obviously, Germany and France have very significant indigenous funds industries, which aren't typically marketed outside those jurisdictions. But for example, so those fund structures will all be subject to the new AIFMD LMT requirements, which at a base level require every fund to adopt at least two of those LMTs that we just mentioned. In the context of the retailization of private assets, so the LTIF in Europe, the LTAF in the UK, the BDC or the interval fund in the US. So here we have products that deliver highly liquid assets in closed-ended or semi-closed-ended structures to retail investors. There is a lot of sensitivity and focus around the potential mismatch of expectation around liquidity, particularly. So retail or high net worth investor expectation is frequently misaligned with the reality of the way in which a fund is structured, notwithstanding clear communication of highly liquid nature of the fund and flexibilities to extend or render fully illiquid an investment in the fund documentation. So it is key for investors to really appreciate just how these various tools can be activated.
Super interesting. Thank you. I think for me, what comes through when we're looking at how capital is being allocated between real estate and private credit, what really comes through is that outcomes aren't just about where the capital is deployed, but how it's deployed. So I'd quite like to zoom in on the structural and governance side of this, because when conditions are tightening, when you see fund terms and control rights and legal frameworks kind of ending up mattering far more than expected, particularly with family offices committing long-term capital, where are you seeing meaningful changes in how private credit or real asset funds are being structured? And where do you think family offices should be paying closer attention today?
Also, very, very interesting question. So we have frequent conversations with our family office client base around the various global offices, and not only our Irish office, but our Luxembourg, our Caribbean offices, Cayman, BVI, and Jersey and Guernsey too, around the optimal structure for any particular family office. So typically it always comes down to the particular investment strategy and goals. Where is capital going to be deployed? How will it be deployed? What are the long-term goals? What is the investor base? Is it purely the extended family, or, as is frequently the case, disparate strands of the family together with co-investors internationally who may be contacts of friends of the broad family office members? Over the last few years, we have certainly seen significant assets coming into Irish regulated fund products from family offices, which is novel. So it wasn't always the case. Certainly earlier parts of my career, family offices would just default to the more traditional family office jurisdictions, so Jersey, Guernsey, and Cayman, BVI. But we're certainly seeing an uptick in the use of regulated fund structures, both Irish regulated fund structures and Luxembourg structures, as an efficient means of allocating wealth without any day-to-day control to second and third generation beneficiaries, but also as a useful and flexible co-investment vehicle to facilitate wealthy friends and associates of the family investing. So say you have a family office that's based in the Middle East with family members across Europe and also wealthy contacts and friends across Europe, and they want to bring all of them into this asset holding structure, which could be for a family business with some ancillary assets, or it could actually be a mixture of family assets and active management. So we frequently see the regulated fund structure being deployed in that context. Just to get into the weeds a bit around some of the structuring changes that need to be borne in mind and new opportunities coming up around them. So in the context of private credit, Ireland and Lux dominate that marketplace in terms of fund structuring. There is some unique tax and reg benefits arising from the Irish-US tax treaty, which is relevant to funds lending directly into the US and some other lending strategies. There is a lot of change coming into play in connection with European private credit with AIFMD2. So it is a new pan-European framework that regulates direct lending funds for the first time, and that comes into play from April of this year. So it does facilitate closed-ended and evergreen structures. There's new leverage limits depending on whether it's closed-ended or evergreen. There's new risk retention obligations. So if a fund originates a loan and then sells it on, in certain circumstances, the fund is required to hold on to 5% of the loans originated. I mentioned the codification of the LMTs, or the liquidity management tools. That's certainly something to be mindful of. And then one point to flag, I guess, in the context of AIFMD2 is that there is a frequent misconception around lending activity itself in the context of loan origination. So there is a misconception that with AIFMD2 there will be a new lending license across Europe, which isn't the case. So there is no lending license for funds under AIFMD2. So there is some references in the directive to a lending license being something that should be operationalized, but there isn't any teeth in the actual body of the directive or the rules themselves. So if you're setting up a credit fund and you want to avail of lending opportunities across the EU, don't look to AIFMD2 to provide an easy fix in terms of going into certain jurisdictions and actually originating lending. So it is still very much governed by country-specific rules. And in some countries, it is permissible to lend to corporates without a local lending license, and in others, a lengthy and onerous licensing regime applies. In terms of real asset strategies, there tends to be a lot of regional variation. So deals involving UK property and tax transparent structures will generally still always use the JPUT, the Jersey Property Unit Trust. The fundamentals in the UK European real estate have remained strong despite value erosion. And in the UK, demand continues to outstrip supply in all living sectors in the office market. And we're still seeing significant increase from APAC and Singapore family offices into UK real estate. Locally in Ireland, we're seeing an uptick in Australian superannuation money coming into Irish real estate, and Ireland seen as a diversification play away from overexposure to the UK market. And then again, we're seeing a lot of real estate focused family office strategies being deployed through Irish regulated fund structures, which are flexible, tax efficient, and have a streamlined 24-hour regulatory approval process. So I guess, Hanna, in short, there's a huge number of factors at play in terms of any structuring determination, and it is an area of constant flux, but there is always new opportunities and new options emerging out of the woodwork.
Now, I'd be curious to hear both of your views on the kind of following. When deals don't go to plan, what, in your experience, tends to matter the most? Is it about fund structure? Is it more a governance issue? Is it manager behavior? And in turn, what does that mean for investors committing capital today?
Do you want? I'll take this one if you like. So yeah, if you're at the stage where deals haven't gone to plan, fund structure for me is what matters most. It is probably a Venn diagram though, and the three factors do overlap. But a fund's governance will be partially at least a function of the fund structure and the level of governance mandated by that fund structure. Similarly, manager behavior and the discretions managers can exercise will also be dictated to a large part by the fund structure. So, if an investor expects that the investment journey will be more turbulent in the coming years, there's a lot to be said for shelling out the few additional basis points for a regulated Irish or Lux fund structure, and the benefits of, by way of example, the rigorous AIFMD provisions relating to depositories and oversight of delegates, to just give that extra level of comfort and security against an uncertain backdrop.
Joseph, any view on this?
Yeah, I think, I'm looking at real estate really pretty much on the direct side rather than through the funds. And I think that, when things don't go right, generally it's the entry price that's causing the problem. And that's the root of it all. Most of the time, if you get the entry price right, then it'll either come out at par or at worst, or it'll work out as a great investment. So I think that's the key part of it. And I think that we're in a sort of landscape at the moment where entry prices are quite compelling, and we're seeing for the first time in a very long time opportunities to buy real estate at below replacement cost here in Europe, which we haven't seen for a very long time, and the reason for that is twofold. One, construction costs have gone up, so exponentially in the last few years post-COVID, we've seen construction costs double or even more in some jurisdictions. And then with the way that values have gone as well, it's been a sort of double whammy. So you get the opportunity to really buy it, on a sort of long-term basis below replacement cost, which I have to say, the demand is always going to be there in one shape or form, depending on what asset class you're in. And so you're always going to be in a relatively good spot if that's the case. When things go wrong, I would suggest it's normally the entry price that's the root of the problem.
Yeah, I think it's fair to say that risks tend to show up at the same time or at the same place, but not all of them every time. Zooming out slightly, looking at what really drives the outcome when markets are less forgiving. When returns are disappointing or when you're preserving capital, would you say it's the asset, the structure, or the people behind it? And how should investors think about that trade-off today? When we're looking at what really matters for outcome, Joseph, do you think it's a good vintage now to deploy capital, or is patience still a strategy? And what would you be watching for before leaning in?
So, in general, I would say it's a good vintage. Now, obviously, with real estate, and like any answer, there's got to be some caveats to that. So, you've got to look at the different asset classes. In recent years, we've seen a lot of capital going into industrial, logistics, and residential, data centers, and also life sciences. And that capital has sort of been refocused away from some of the more traditional classes like the retail and the office markets. So each market you have to take, or each asset class within the real estate sector, you've got to take on its own merits and where it is in the cycle. There's one bit of research that we produce, which is what we call the bid intensity index, and I think that's interesting for two reasons in this specific context. The first is it tells you roughly the depth of bidding and where the pricing is relative to the ask at the outset. So you can see if we're meeting what the guide price is, or whether we're undershooting it, or equally whether we're surpassing it. And if you look back on the sort of history of that, you can also see which asset classes have had, I'd say, more of a repricing, where the bid-ask spread has widened out, and we've been a long way behind, or some way behind where the ask was. And obviously, as you go forwards and the market starts to correct, you see that spread narrowing again. So you can see which asset classes have probably had more repricing than others. You can also see what the depth and the competition is for the asset classes at any given time. Now that's a global sentiment tracker, effectively, from all of the bid data that we're receiving and the sales data that we're involved in. But it's quite a good reference point just to give you an overview in terms of where we see the market at the moment. I think that if we're trying to go a little bit further in terms of is now a good moment, I would come back to my earlier answer in terms of a lot of family offices are just looking at not necessarily IRRs or what the sort of returns are over a fixed period, but just what's my overall cost basis per square meter, per square foot, and what does that look like on a relative basis to where we were 5 years, 10 years ago, 15 years ago. Does that sound like a reasonable entry point? And then oftentimes in many different asset classes, the answer is yes. If you look at offices, you could have been buying a stabilized asset at 30,000 euros a meter. Now you can buy the same one at 22, 20, somewhere in that sort of range. And on a long-term basis, that looks pretty compelling. So my answer is, as with all good answers, yes, now's the time to be investing, but it obviously depends on the specific asset and the specific opportunity. But I'd say there is a weight of money in some sectors of the market, especially on the sort of value add and opportunistic part, the core plus part of the market, where there's you've got a cash flowing asset that is probably slightly less competitive, as is the core end of the market, and that's where you can find some really good opportunities at the moment.
Very interesting. Now, often when market conditions are tightening, what tends to make the biggest difference to outcomes from a structuring and governance perspective? Where would you say that investors realized too late that protections weren't as strong as they thought initially?
Yeah, so Hanna, the best way for me to answer that question is probably to take a couple of examples I've seen in my career of highly stressed situations, and which have really negatively impacted on investors, and just how structuring governance really mattered in those scenarios. So the first one is Madoff tainted litigation. So this is something that has been very real to a number of fund structures across all the major fund jurisdictions over the last 17 years. Some of the Madoff related litigation is just literally resolving in the courts in the US, like late last year, early this year, and some of it's still rumbling on. So here, for example, we have situations where maybe it could have been a Lux fund or an Irish fund or a Jersey fund or a Cayman fund investing down into an underlying fund, which in turn had exposure to the Madoff Ponzi scheme. Some of these funds were invested in the early noughties, mid noughties, redeemed out long before Madoff blew up. Obviously weren't in any way complicit in any sort of fraud. We're assuming that that the fund they were investing in, the underlying fund, was again, there was no fraud at that level. It was investing, getting some sort of Madoff exposure. But essentially what happened was the trustee in bankruptcy of the Madoff estate sued any entity that in any way profited from Madoff before Madoff blew up. So you have situations where maybe Cayman or BVI funds that were underlying funds investing in Madoff on behalf of Luxembourg funds, Irish funds, Jersey funds, other Cayman funds, were dragged into this litigation where the underlying fund was being sued by the trustee in bankruptcy of the Madoff estate, and that underlying fund itself was then turning around saying, well, we obviously don't have these redemption proceeds that we received from this Madoff structure. We gave them back to our underlying investors, so the feeder funds, and they joined all of those funds that fed into them as parties to the litigation. So from an investor's perspective, it could have only been a small portion of the fund's actual investment, but you had situations which in some circumstances have gone on since. So funds were suspending dealing in 2011, 2012, when they were they were brought into these litigation proceedings. In some contexts, those funds are still suspended. The investors have not been able to get their proceeds back for what is now pushing 13, 14 years. And at the same time, they've been just watching from the sidelines as their asset pile is incrementally depleted by what are substantial litigation costs, particularly in the US and the Caribbean, year in year. And some of the interesting discussion points and focus points that have come out of that have really been laser focused discussions, engagement, in some cases litigation around some of the finer terms of the fund documentation. So what does your constitutional document say about suspending dealing, and what happens to an investor who had a redemption request that was received and processed by the redemption deadline, but was still, the redemption proceeds hadn't gone back to the investor within the 60 days or the 45 days provided in the fund documentation. And is that investor now a creditor of the fund, or is that investor still a shareholder tainted by this suspension? So I guess it's in those types of highly distressed situations that the nuance of the fund documentation really comes into play, and that's when it really pays to have really done your homework, done the due diligence, really gone through the fund documentation, really read the fine print and appreciated what can happen in a worst case scenario, and are my interests best protected in those scenarios.
Thank you, Josh. And I don't think there are any easy answers here, really, but that's probably the point of us getting together. I think for me, the one thing that really stands out from today's discussion is that selectivity isn't just about choosing the right asset or the right strategy, but it's really about choosing the right structure, the right manager, and the right terms, particularly for those who are deploying long-term capital. But with that, I'd like to thank our panelists for a very thoughtful and candid discussion. Thank you all for your engagement and questions from the audience. And of course, a special thank you to the Private Markets Group for organizing the session. Thank you so much.